Welcome to our market update for July 2025. So the share market and world economy has been rattled over the last 6 months by a lot of macro uncertainty relating to geopolitical events, as well as relations between the US and the rest of the world. We've been fighting through inflationary risks which have been abating in the background over the last few years, and certainly the geopolitical events in recent times has made us more wary and cautious around the inflation risks going forward. To date, those risks haven't actually translated into higher actual inflation just yet, but we are wary of that. The other area that the uncertainty has kind of really impacted is the consumer and business confidence levels, which impacts significant parts of the economic growth pie, as well as business investment decisions. Over the last couple of months, we've seen a big back down and backtracking from President Trump regarding his tariff policy program. Markets have really latched onto that, and it's really resulted in what's called the taco trade, which is Trump always chickens out, but we'll kind of get into a little bit more on that shortly. But that certainly provided relief to share markets, and we've seen a very strong rally over the last 2 months as a result of that. We'll talk a bit about how that has impacted valuations, which are now back to expensive. As I said, inflation generally under control. Certainly there are risks to the upside through either wars, the impact on the price of oil, or via tariffs, which are still in the background and aren't going to go away completely. Implications for interest rates. We have seen a lot of interest rate cuts so far in the global economy, 64 to be precise, over the course of 2025, and we are expecting more easing ahead. We'll then get into a little bit of commentary around the domestic versus international share market perspective, a few examples of companies in the Aussie market, both on the expensive side and on the fairly valued side, and then we'll jump into implications for portfolios. So as I said, uncertainty is very high. That's really stems from the economic and trade policy platform from President Trump. And it's a problem for the economy and the share market because it does impact confidence for consumers and businesses, which slows investment decisions, which slows consumption, and ultimately feeds through to lower or slower corporate earnings growth. So we'll have to wait and see how that kind of plays out. So far, we have seen earnings growth kind of flatten out a little bit in the US. There are reasons why the US is better placed than other places around the world from an earnings growth perspective, namely investment trends around technology, AI, and the like. But we are seeing a cyclical slowing in earnings generally because of the geopolitical forces at play. As I mentioned, the taco trade has really driven markets over the last 2 months higher. Trump always chickens out. That is, he backs down from his policies. He puts up very strong words, strong messages, and then walks them back after he gets the deal that he wants. We have seen that happen, and markets have run with that idea. And generally speaking, over the last few months, when there has been some negative rhetoric from Trump, markets have really ignored it or shrugged it off. So the risk is that some of that does not happen, as in the tariff postponements, which are set to expire on the 9th of July, maybe don't get extended in terms of those delays, and markets would react badly to that. So there's certainly still risk out there from a Trump tariff policy perspective, and I think the markets may be just a little bit too complacent about that risk. From a domestic economic perspective, there are some green shoots, there are some reasons for positivity, namely around the fact that inflation does continue to trend down. Tax cuts have started to flow through, interest rates are on the downward slide. All of that will translate to higher household income and consumption from households. We are seeing a similar story play out in other parts of the world as well, which is certainly a good thing for economic growth and ultimately corporate earnings growth. As I mentioned, inflation does continue to trend down across the world and here in Australia as well, which is good news. It does mean that interest rates can be lowered from here. And in terms of what those interest rate cuts look like over the next 6 months or so, we are expecting 2 to 3 more interest rate cuts here in Australia over the course of 2025, taking rates down towards 3%. And those lower interest rates will flow through to providing relief to households with a mortgage, of which there's about 1/3 of the population, or 1/3 of households have a mortgage in Australia. And that's particularly important for the Australian economy because household service charges or debt service ratios are extremely high in Australia, amongst the highest in the world. So that relief from lower interest rates will certainly be welcome from households. Now, just changing gears a little bit, looking at the share markets both here in Australia and over in the US. Over the last 12 months, we've seen both domestic and international share markets rally quite firmly. And the reasons for that, some of them I've just talked about, but the fundamental reason that the US share market is higher is because the corporate earnings are higher, they're stronger, really being buoyed by technology investment trends, particularly around AI. So the US share market is a big beneficiary of that, and we expect that will continue going forward. However, in Australia, most of the share market rally hasn't been driven by fundamentals. It hasn't been driven by earnings growth. It's been purely driven by sentiment, and valuations have expanded as a result of that rally. So we are not as positive on the Australian share market as we are on the international market for that reason. And when we kind of take a step back and we think about what actually drives share prices over the long term, and we talk a lot about earnings growth, the reason we do that is because fundamentally corporate earnings is the key driver of share prices over the long term. In the short run, earnings could go up and the share market could go down. That does happen. Sentiment is a short-term thing. Bad news can come out on a geopolitical level. Share market goes down. Corporate earnings can continue to grow in that environment. And ultimately over the long term, it's those earnings that count. So what we've got here on the screen is just showing the US share market in blue. We can see that over the last decade or so, the US share market is up about 180% over the last 10 years. And that's been supported by corporate earnings growth of about 122%. If we think about Australia, our share market has only seen share price growth of 26% over the last 10 years. So a little over 2.5% per annum. Now, dividends do boost returns in Australia by quite a lot because we're getting 4% to 5% dividend yields here in Australia. So that does boost the total return upwards to kind of around 6.5% per annum. But that does pale in comparison to the US, where you're getting kind of 18% per annum on average. And the fundamental difference between the US and Australia clearly is that the US is a growth market with companies that innovate, that provide solutions, services, products that can generate high returns on capital and ultimately stronger earnings growth. So that's why we like international markets, and that's why we've seen such a strong outperformance of international over the Aussie market over the last decade. And to be honest, going forward, we don't really see that changing. Unless we saw a fundamental change in the Australian share market landscape, there's not really any reason to suggest that historical trends will materially change. When we think about a couple of the largest Aussie companies, I think it just kind of paints a bit of a picture of what's been happening under the hood. So CBA, largest Australian company, we've seen the share price over the last 10 years increased by around about 115%, so 11% per annum. Over that time frame, earnings growth have grown 10%. That is, they've grown 1% per annum. So almost zero earnings growth, zero fundamental growth from CBA, despite the fact that the share price is up over 100% over that same time frame. Now, yes, it's paid dividends, but to be honest, the yield on CBA is actually not very high. It's less than 4% per annum, closer to 3%. And the valuation for CBA is at eye-watering levels. It's the most expensive bank globally, and the forward growth projections for CBA are actually pretty modest, high single digits at best. So that's really CBA being one of the biggest drivers of the share market, particularly over the last 12 months. So we're quite cautious on CBA from a valuation perspective. We think it's a very crowded position. It's a crowded trade. And unless the earnings growth materially increases going forward, I would definitely be quite cautious on CBA. In contrast, CSL has grown its share price and earnings at over 100% over the last 10 years. So there's nowhere near the same level of exuberance embedded in the CSL share price today. So if I was thinking about a large quality company that I would like to accumulate at this point in time, CSL definitely is one of those, because we just haven't seen the valuation expansion that we've seen in other parts of the market like CBA and financials in general. So there's a much larger margin of safety in CSL and in the healthcare sector generally. So putting it all together, what does it mean? We think that macro volatility is going to continue going forward. There's no reason to suggest that it's not. We retain a preference for international equities over Australian shares for the reasons I've talked about: quality, breadth of opportunities, innovation, and earnings growth as a result of all of those things. But within markets, there's definitely more potential, I think, for being selective, as I've kind of alluded to when we think about a simple example of the Australian market comparing companies like CBA and CSL. There are very clearly companies that we have a preference for, and there are very clearly companies that we have a preference against. Within defensive investments, such as fixed income, we haven't talked about that in today's presentation, but we have in previous presentations, and we continue to like fixed income for the capital stability, for the high income generation that it provides. Cash is always a good idea to have a little bit of cash to take advantage of volatility, and it can add value to your portfolio if you put cash to work when the market is down, and take some profits when prices have run very, very hard. And yeah, it's really about managing the volatility and trying to generate returns that are consistent with your long-term return goals in the lowest risk possible. And so that's why asset classes like fixed income, particularly today, we think provide a very good risk-adjusted return, because you're getting levels of income or return that are consistent with most client objectives, around that sort of 7 to 10% per annum, but you take much, much less risk. The volatility within fixed income is significantly lower than equities. So that's why we continue to like and lean on fixed income within portfolios. So look, thank you for your interest. Thanks for watching today's video. If you do have any questions, reach out to your advisor or myself. So thank you.